Financial. We're the place you come to forge a stronger portfolio and to cut right through all that market noise. Today, we are putting a true titan under the microscope, Thermo Fisher Scientific. Now, this is a giant in the life sciences industry, a company that, by all accounts, should be a bedrock of stability in any portfolio. But right now, it is sending some seriously mixed signals. So we're going to dissect their latest earnings report piece by piece and figure out if this company is an unshakable fortress for your money or if we're starting to see the first cracks in a very, very heavy foundation.
Okay, let's get straight to the point. Here is the paradox that has Wall Street scratching its head. And frankly, it's why we're talking about this today. On paper, Thermo Fisher's fourth quarter earnings report was an absolute home run. I mean, they beat analyst expectations, they raised their future guidance, and they painted this beautiful, rosy picture of what's to come. It was literally everything you could possibly want to hear from a blue-chip stock. But the market's reaction? It wasn't a round of applause. It was a sell-off. The stock took a nosedive right after the announcement. And that, right there, is the mystery we're here to solve. What is causing this disconnect? Is Wall Street seeing something that the headline numbers are trying to hide?
That's exactly right. And let's be crystal clear about this. We are not talking about some minor dip here. The stock dropped by nearly $24 a share. For a company of this size, of this magnitude, that is a significant haircut. If you were an investor holding this stock, that drop was a very real and I'm sure a very painful event to watch happen on your screen. So the real question becomes, is this just a temporary knee-jerk overreaction from the market, maybe creating a buying opportunity, or is this a legitimate warning sign that something is fundamentally wrong under the hood of this company?
And this is precisely what makes the whole situation so fascinating. You have the CEO, Mark Casper, on the earnings call projecting nothing but pure, unadulterated confidence. I mean, listen to that quote. He's not just saying they had a decent quarter. He is practically promising an excellent 2026. That is a bold, forward-looking statement. So we're left with this really stark contrast, a CEO painting a picture of a company that is firing on all cylinders, just running perfectly, and a market that seems to be running for the exits as fast as it can. This whole thing isn't just about the numbers anymore, it's about credibility. Who do you believe? Do you trust the company's own narrative, or do you follow the market's cold, hard verdict?
All right, to get to the bottom of this, we need to be methodical, we need to be systematic. So first, let's build the bull case. Let's put on our construction hats and examine the financial bedrock of Thermo Fisher. We're going to see just how strong this company's foundation truly is. So let's roll up our sleeves and dig right into the numbers. Let's start at the top line, revenue. In the fourth quarter of 2025 alone, Thermo Fisher pulled in over $12 billion. Now, to put that number into some perspective for you, that is more than the annual gross domestic product of some small countries. This isn't some high-flying startup, folks. This is a massive, global, revenue-generating machine. This figure tells you everything you need to know about their incredible scale and their deep, deep integration into the global healthcare and research sectors. But you know, the absolute number is only half the story. The real question is, which way is that number heading?
And right here, here's your answer. As you can clearly see, that massive revenue figure is up 7% year over year. Now, for a company of this immense size, that is solid, dependable, impressive growth. Look, it's not the kind of explosive shoot-for-the-moon growth you see from a small tech startup, and it shouldn't be. This is the kind of steady, powerful expansion that builds real long-term value for shareholders. This tells us their core business is fundamentally healthy. So the top line is strong. It's a solid pillar. Now let's look at the bottom line. Okay, now for the number that really, truly matters to shareholders, earnings per share, or EPS. In the fourth quarter, Thermo Fisher delivered an adjusted EPS of $6.57. This is the ultimate measure of profitability. It's the bottom line. It tells you exactly how much profit the company is generating for each and every individual share of its stock. This is the number that directly translates a company's operational success into tangible value for investors. And on its own, 657 is a very strong number. But again, the real story is in the trend. And here we see it in black and white, an 8% increase in adjusted EPS compared to the exact same quarter last year. Now, what's really interesting here, and this is a key point, is that earnings are actually growing even faster than revenue. What does that tell us? It tells us that the company isn't just getting bigger, it's getting more efficient, it's getting more profitable. They are managing their costs effectively and are literally squeezing more profit out of every single dollar of sales. This right here is the hallmark of a disciplined, well-managed company. It's a cornerstone of the bull case, and it suggests a very, very solid operational foundation. And here's the real kicker. They didn't just meet expectations, they absolutely shattered them. Think about this. Wall Street analysts,
The people who are paid fortunes to model these companies down to the very last penny were left completely in the dust. Thermo Fisher beat revenue estimates by over 2.2% and EPS estimates by over 2.1%. This is not a rounding error. In the world of multi-billion-dollar companies, this is a significant, undeniable outperformance. So let's just recap the bull case so far. Strong revenue growth, even stronger profit growth, and they're exceeding all expectations. So why on earth did the stock fall? Before we move on from the bull case, let's just take a quick look inside the engine room. As you can see, their most critical market, their bread and butter, pharma and biotech, is firing on all cylinders with high single-digit growth. This is their core business. This is the segment that funds the research, that fuels the acquisitions, and that pays out the dividends. Sure, you can see there are some weaker spots in their industrial and government-facing businesses, but the main engine is running strong and fast. So from a purely numbers-based perspective, the bull case looks absolutely airtight. The foundation, from this angle, appears to be made of solid granite. Hold on a minute. Granite? That's a pretty bold claim. If the foundation is so solid, I have to ask again, why did the stock drop $23? You've built a really convincing bull case, I'll give you that, but it feels like we're only looking at one side of the blueprint here. I think it's time we put on our hard hats, grab our flashlights, and start actively searching for cracks. The headline numbers are impressive, no doubt, but the market is often a lot smarter than the headlines. Let's see what the bears are seeing. Exactly. The market doesn't just panic for no reason. It's a forward-looking mechanism. It's not just reacting to what happened last quarter. It's pricing in what it thinks is going to happen next year and the year after that. So if the structure is really so strong, why are there tremors? Why is the ground shaking? We need to go beyond the impressive facade and start examining the pressure points. Where is the stress really building up in this company? Let's find out. Here it is. Here's the first crack we found. A contraction of 113 basis points in their adjusted operating margin. Now, for those who don't live and breathe this stuff, a basis point is just 1/100%. So this is a 1.13% drop in their quarterly margin. In simple terms, for every dollar of sales the company makes, it's keeping less as actual profit. This is a classic warning sign. It suggests their costs are rising faster than they can raise their prices. And that is a major red flag for investors who care about profitability. It's an erosion at the edges. And here is the culprit, straight from management's own mouth on the conference call. Over 100 basis points of that pressure came from two big things: tariffs and foreign exchange. Now, these aren't small internal problems that a good manager can just fix. These are massive macroeconomic headwinds. Tariffs mean geopolitical risk, a potential trade war that can escalate without any warning. And foreign exchange volatility. That means the profits they earn in Europe and Asia are worth less and less when they're converted back to US dollars. The crucial point here is that these are factors largely outside of the company's control. And if there's one thing the market absolutely hates, it's uncertainty. Now let's dig into geography because this is important. As this table shows, while Europe and North America are doing okay, chugging along with some growth, China is a major problem. A decline in low single digits for the quarter. You have to remember, for years and years, China has been a massive growth engine for global companies like Thermo Fisher. So seeing that engine sputter and actually go into reverse is a huge red flag. This isn't just about one bad quarter. It raises a fundamental question about their whole growth story. Can this company keep growing if its biggest growth market is now in decline? The market is clearly worried about the answer to that question. And finally, let's talk about the weight on this foundation. Let's talk about debt. The company is carrying nearly $40 billion in total debt. Now look, for a company this size, some debt is normal, even healthy, but this is a heavy, heavy load. And what's even more concerning is that they're about to take on even more debt to fund a massive new acquisition. In a rising interest rate environment, like the one we're in now, this much debt becomes more expensive and a whole lot more risky. It reduces their financial flexibility to weather a storm or pounce on an opportunity. So the question is this a strong foundation, or is it one that's about to buckle under its own weight? Those are all completely valid points. The margin pressure, the slowdown in China, and that mountain of debt are all very real concerns that any serious investor needs to consider. But the market doesn't just look at the present, it's always pricing in the future. And to understand Thermo Fisher's future, you have to look at their blueprint. They are not sitting still and waiting. They are aggressively building for tomorrow. So let's examine that blueprint and see if the future they're building justifies the risks they're taking on today. This chart tells you the whole story of their strategy in one picture. They deployed over $16.5 billion in capital last year alone. But look where the money went.
the vast, vast majority of it, a staggering $13 billion, went directly to mergers and acquisitions. This isn't a company that's just tinkering around the edges or making small improvements. This is a company that is actively buying its future growth. It's an aggressive, high-stakes strategy, and the centerpiece of it is their next big move.
And here it is, the $9 billion bet on the future, the acquisition of a company called Clario. This isn't just another bolt-on acquisition designed to add a few percentage points of revenue here and there. No, this is a transformative deal. They are spending big to buy a clear leader in the clinical trials data space. This move tells you exactly where they believe the future of the entire life sciences industry is heading, and it's all about one thing: data. So what exactly is Clario? Well, you can think of them as being right at the heart of modern drug development. They provide the critical software and the essential services that pharmaceutical companies use to manage all their clinical trial data. We're talking about things like patient-reported outcomes, medical imaging, cardiac safety data, all the crucial information. By acquiring Clario, Thermo Fisher is embedding itself deeper and deeper into its customers' most critical work. They're making a strategic shift from just selling lab equipment to becoming an absolutely indispensable partner in the entire drug development process. This is a brilliant strategic move to create a stickier relationship with their clients, making it incredibly difficult and expensive for them to ever switch to a competitor. They don't just want to sell you the workbench anymore, they want to own the entire workflow. And look, it's not just about buying growth. They're also building it from the ground up internally. As you can see, they're not just resting on their laurels. They're collaborating with cutting-edge partners like OpenAI on AI integration and with the Chan Zuckerberg Institute on advanced biological imaging. They are at the absolute forefront of innovation, launching groundbreaking products that no one else in the world can match. So while the bear case is focused on the debt and the risk, the bull case sees a company that is making the necessary, albeit expensive, investments to absolutely dominate the next decade. They are doing the heavy lifting right now to build a stronger, more fortified future. All right, so we've seen both sides of the coin. The bull case rests on a foundation of solid growth, increasing profitability, and an aggressive forward-looking strategy. The bear case points to some very real cracks in that foundation: margin pressure, a serious slowdown in China, and a mountain of debt. So what's the final verdict? Is this recent stock drop a golden opportunity to buy a great company at a discount? Or is it a trap waiting for unwary investors to step into? This slide lays it all out, side by side. On one side, you have the bedrock strengths, the kind of fundamentals you dream of seeing in a long-term investment. You've got consistent, reliable revenue and earnings growth. You have clear dominance in their most important market, pharma and biotech. You have an aggressive M&A strategy that shows they're playing to win, and a strong innovation pipeline that proves they're not standing still. But on the other side, you have those potential cracks, and these are not insignificant risks. Macroeconomic headwinds like tariffs and currency fluctuations are powerful and completely unpredictable. China is a huge question mark for their future growth. And the Clario acquisition, for all of its strategic promise, is a massive undertaking that carries significant execution risk. All of that, sitting on top of a huge debt load, makes the entire structure more vulnerable to shocks. And here's the company's own outlook for the year ahead. They're forecasting solid, respectable growth in both revenue and earnings per share. But what's really, really interesting is what's not in this forecast. First, this guidance assumes that the tariff situation doesn't get any worse, and in today's geopolitical world, that is a big if. Second, and perhaps more importantly, this guidance does not include any financial impact, positive or negative, from the massive Clario deal. That means there's potential for both negative surprises from the macro environment and, hopefully, positive surprises from the acquisition. This guidance is just the baseline. It is not the full story for 2026. So, we come right back to our central question. Thermo Fisher is undeniably building a massive structure for the future. They're making bold, expensive, and ambitious moves to stay on top of their industry. The ambition is crystal clear. But the weight of that ambition, the $40 billion in debt, the risks of integrating a $9 billion company, the exposure to unpredictable global forces, that weight is immense. The market's recent negative reaction suggests a real, tangible concern that the foundation, while strong today, might not be strong enough to bear that incredible load without developing more serious cracks. So the final question for every investor looking at the stock is this: do you believe in the blueprint, or do you fear the weight? That is what you need to decide.